Welcome back to News Nexus. I'm Nancy, and today we're diving into a fascinating topic that touches everything from the prices we pay at the store to the global financial systems that shape our lives. Trust in economics and how the invisible hand plays a crucial role in holding the market together. The concept of the invisible hand was first introduced by the Scottish economist Adam Smith in the 18th century. He argued that when individuals act out of self-interest in a free market, they unintentionally promote the public good. But while that idea might sound straightforward, there's one crucial element that makes the invisible hand work effectively. Trust. Trust is the unseen force that allows the market to function smoothly, and today we'll explore how it impacts everything from small transactions to the global economy. Markets, at their core, are exchanges between individuals or businesses that may not know each other personally. Picture this. A buyer walks into a store, buys a product, and leaves. They may never see the seller again. But despite the brief interaction, a crucial element is at play: trust. The buyer trusts that the product will meet their expectations, and the seller trusts that they'll receive payment for their goods or services. Now think about how this works on a global scale. In today's digital age, we make purchases online from people we may never meet. We rely on platforms like Amazon, eBay, or even smaller local sellers to deliver the goods we order. But why do we trust these transactions? The key is that we trust the systems that these platforms have put in place, whether it's their reputation, the guarantees they offer, or the reviews left by previous customers. This trust reduces the friction of the transaction. Without it, we would spend more time checking every detail, making sure we're not being cheated and worrying about whether the deal is going to fall apart. And when trust is in place, the market functions more efficiently. Businesses don't have to spend excessive resources on verifying each customer or supplier, and consumers don't have to question every purchase. But trust doesn't just exist between buyers and sellers. It also plays a huge role in how we interact with institutions and the government. Think about the financial system. People don't just trust their local bank. They trust the entire banking system. We believe that when we deposit money into our accounts, it's safe and secure. We trust that the laws of the land will protect our savings, and that we won't lose our money due to fraud or corruption. This trust extends to every institution that keeps the market running smoothly: the courts, regulatory agencies, stock exchanges, and even the tax system. Without the trust that these institutions will uphold contracts, settle disputes fairly, and regulate the economy properly, markets would collapse. Trust in government policy is just as crucial. For example, when we think about monetary policy or government spending, we're trusting that policymakers are acting in the long-term interests of the economy. When that trust is strong, people are more likely to make decisions that contribute to economic growth, whether that's saving money, investing, or starting a business. But what happens when that trust breaks down? That's when markets fail, and things can go wrong in a big way. One clear example of this is a market bubble. A bubble happens when investors place too much trust in an asset, whether it's housing, stocks, or even cryptocurrency, and the price gets inflated beyond what it's actually worth. When that trust collapses, the bubble bursts, leading to a sharp decline in prices and often triggering an economic crash. The 2008 financial crisis is one of the most dramatic examples of this. In the years leading up to the crash, people trusted that housing prices would keep rising. Banks trusted that they could sell risky mortgages to unsuspecting buyers, and investors trusted that everything would continue to grow. But when that trust unraveled, the whole system came crashing down. Markets can also suffer when trust in individual businesses erodes. Think back to the 2015 Volkswagen emissions scandal. The company was found to have cheated on emissions tests, which severely damaged its reputation. Consumers lost trust in the brand, and sales plummeted. This is another reminder of how fragile trust can be, and how quickly it can undermine a market. But what happens when trust is restored? History shows that markets are resilient. After the 2008 financial crisis, global economies slowly recovered. New regulations were put in place, and efforts were made to rebuild trust in the financial system. Similarly, when a company rebuilds its reputation after a scandal, consumers may return if they believe the company has genuinely changed its practices. Rebuilding trust is difficult, but it's possible, and absolutely necessary for a functioning economy. Whether it's through government reforms, corporate transparency, or greater accountability from financial institutions, trust can be regained. When it is, the invisible hand can continue to do its work, guiding the economy forward in ways that benefit us all. The invisible hand works because of trust, and without that trust, markets become unstable and unpredictable. This brings us to one of the most critical lessons of economics. Trust is not just a nice-to-have element. It's fundamental to the way our entire economic system operates. When trust is strong, markets thrive, innovation flourishes, and economies grow. But when trust is broken, the invisible hand falters, and we risk market instability and economic turmoil. So, as we've seen today, the invisible hand is more than just a metaphor. It's a real force that keeps the market functioning, driven by the trust we place in one another and in the systems that govern our economy. Whether we're making small everyday purchases or engaging in large financial transactions, trust is the glue that holds the market together. As always, thanks for tuning in to News Nexus. If you enjoyed this deep dive into the world of economics, make sure to hit that like button, subscribe, and share this video with your friends. We'll be back soon with more thought-provoking content. Until then, stay curious and stay informed.